Let's get to our guest, Ashraf Laidi, who is Chief Global Strategist at City Index. Ashraf, let's talk about the risk currencies because the Australian dollar really throwing a curveball to many traders out there, first with the interest rate cut on Tuesday and now with this strong Q1 data. Do you think traders have been just a little bit too nervous about the prospects for economies like Australia?
You could say that the traders were a bit too nervous, but let's not get too excited about the GDP. GDP numbers are lagging indicators. Yesterday we saw the trade numbers from Australia, and the deficit, and the country went into a deeper current account deficit, which will be reflected in the next release of GDP by eroding further growth from there. Any rebound in the Aussie would likely to be limited at parity. So that's one part of the risk currencies. The other risk currency is the Canadian dollar. Even though the Bank of Canada yesterday came out and did not reverse their intention to tighten policy, we think that they will probably eventually have to do that and to backtrack, partly because of the weakness that we're seeing in the U.S.
Ashraf, we also have a key commentary piece coming up from Ben Bernanke when he speaks to Congress. This seems to be really important because last time round at the FOMC meeting, things have really moved on since then. We've seen an escalation in the crisis, further optimism that there's going to be stimulus in the form of QE3. How is this changing the way people are positioning and think that Ben Bernanke is going to be speaking to the market?
Absolutely. You've said the right word, positioning. We are already into quote-unquote extreme euro short, extreme dollar long positioning. The catalyst to reverse the other way or to have a sort of a short squeeze, one of them would be Ben Bernanke's speech, which might open the door towards their attention of quote-unquote doing more. Would that be? It would not be outright QE3. It would be a QE, but with a twist, a sterilized intervention, a sterilized purchases that would kick in June the 20th. That is actually 3 days after the Greek elections, and that would be an excuse for people to stabilize or to take money off the table and to even push the euro probably towards as high as 126.50 or 127 before we could see it come back down again.
Ashraf, there seems to be an obsession with a binary solution to this. Either Europe doesn't manage to solve its problems and we fall mightily from here, or indeed there is a resolution. What about the muddling through scenario and how we invest in that eventuality, which quite frankly seems the most likely as well, the relative valuation of various assets and indeed currencies in a continuation of the current environment? People are saying, oh, there's only 3 months to save the euro, but I have a concern that we're going to see the same kind of trading pattern for many years to come.
Okay, yes, the muddling through, one thing to take the muddling through scenario would be probably an idea that the ECB may start the whole game all over again, LTRO, but this time not at 1%, but less than 1%. It could signal a rate cut, if it not today, maybe later this summer, and it will start the whole game of liquidity provision. That's consisting of a type of muddling through. Then they will have to come out with some money, maybe 30 or 40 billion to help to recapitalize the banks, partially from the EFSF. That is partially muddling through because you're not solving the solvency problems, you're just tackling the liquidity issue, and we might be trading in the range. The key thing that may not make it a binary solution would be what would happen to the U.S. We saw summer 2010, summer 2011, and summer 2012. Well, the U.S. is maybe starting to weaken. If this weakness here really deepens, and if the ISMs in the U.S. will eventually fall below 50, joining the rest of the world or the rest of the G7, that will be a little bit more exciting than muddling through and more exciting than a binary solution.
So far, though, the ISM services number was fairly decent. How long do you think this is going to hold up for, and what's your predictions for the pace of growth we're likely to see in the US?
We will have to really rely on any further oomph that would be signaled from the Federal Reserve and from the authorities, and we think that they will eventually have to do it. With just word of caution that Operation Twist alone from the U.S. might not help. Did not help last time, because last time what really helped things was really the LTRO, the QE3 from the UK, and so we think that any action by the Fed will have to be joined in by the rest of the authorities, and that would be a considered as quote-unquote muddling through.
Well, I scramble to look for positives, Ashraf, in this market. I see ING has started Bank Inter, Banco Popular and Banco de Sabadell with sell ratings saying that only BBVA and Santander are investable Spanish banks at the current levels. One further stage of this crisis has to be the realisation of the severity of the crisis. And when we start saying that banks are uninvestable and with sell ratings, surely that means we're actually getting to grips with reality, and that's another positive.
Maybe. Well, you could say that, but if that will be the catalyst to throw in the towel or to be the capitulation, that might not be the positive. You know, yesterday we heard some stories from Moody's actually downgrading one or two German banks. So, you know, you could be looking deeper into it and you could say that's when to buy, when there is blood in the street.
Yeah, I guess as Mike Bouchard used to say to me in the Bund option pit, the Nile ain't just a river in Egypt, and hopefully we'll be on that stage. Thank you very much indeed for that, Ashraf Laidi, Chief Global Strategist at City Index.